Everyone starts confused, a little nervous, staring at a screen full of numbers that mean nothing yet. However, if you zoom out and look at the journey of almost every serious investor, the same pattern emerges. 8 distinct levels, 8 different ways of thinking about money. And most people never make it past level 2. Let's walk through all of them. Level 1, the beginner. You open an investment account for the first time. The interface looks simple enough. Buy, sell, numbers moving, but nothing about it feels simple. You deposit $500. It's not life-changing money, but it's real money, yours. And that changes how it feels. You scroll through stocks, companies you recognize, brands you've bought from your entire life, and slowly, a strange idea starts forming. You're not just buying a number on a screen. You're buying a small piece of something real. A business, people, a product. That idea takes time to fully land. You make your first investment not to flip it, not to trade it next week, just to hold it, to see what happens. And here's what changes. You start paying attention differently, not just to the price, but to what the company actually does, how it makes money, why people keep choosing it. You start reading earnings reports, analyst takes, different opinions. Some people are obsessed with what the stock will do next Tuesday. Others are focused on what the business will look like in 10 years. That gap, that's your first real decision as an investor. What kind of participant do you want to be? At this level, your returns are almost irrelevant. What you're really doing is learning the language, how markets move, how ownership compounds, how staying in position, not reacting, not panicking, is a skill that actually matters. And when that shift happens, when you stop watching every tick and start thinking in years, you've crossed into level 2. Level 2, the retail investor. You stop investing when it feels right. You start investing every month, no matter what. $500, $1,000, whatever the budget allows, automatic contributions, same day, every month into your brokerage. From there, you allocate index funds tracking the S&P 500, a few ETFs, maybe some individual stocks you've actually researched. Your portfolio starts to take shape, not randomly, by design. You learn what diversification actually means, not just owning a lot of things, but owning things that behave differently from each other under pressure. Then the market drops. Not 1%, not 2%, maybe 10%, maybe more. Everything you've built shrinks on paper. And this is the moment that separates people who build wealth from people who don't. You don't sell. Not because you're fearless, right? But because you understand something now. Volatility isn't the risk. Selling at the wrong time is the risk. So you keep investing. Month after month. Through the downturn, through the recovery. This is called dollar cost averaging. And it sounds boring because it is. That's the point. Your returns are still modest. But your behavior is no longer random. It's structured. You think in years. You track total return, cost basis, allocation percentages. You're not trying to beat the market. You're trying to stay in it long enough to benefit from it. And when your portfolio grows to a size where a 1% move actually means something, that's when everything changes. Level 3, the consistent investor, your portfolio crosses $100,000. That number hits differently. A 1% day isn't abstract anymore. It's $1,000. A strong year can add $10,000 to your balance without you doing anything extra. For the first time, compounding feels real. Your strategy gets sharper. You set a target allocation, maybe 70% equities, 20% fixed income, 10% cash, and you actually stick to it. You rebalance not based on how you feel, but based on percentages. When equities run too hot, you trim. When they fall, you add. You start thinking about risk-adjusted returns. Not just how much you made, but how much risk you took to get there. Drawdowns, volatility, correlation between assets. These start to matter. Market corrections stop feeling like emergencies, they feel like part of the process. You also get smarter about taxes, holding long enough for long-term capital gains treatment, maximizing tax-advantaged accounts. At this level, the edge isn't stock picks, it's discipline. Executing the same calm, structured approach, month after month, year after year, regardless of what the headlines are screaming. And when the portfolio grows large enough that even small percentage improvements mean real money, the strategy has to evolve again. Level 4, the advanced investor. Somewhere between $250,000 and $1 million, the game changes. A 2% improvement in annual returns isn't a small thing anymore. It could mean an extra $10,000 to $20,000 per year. Suddenly, optimization matters. You go beyond basic allocation. You study how different asset classes behave during market stress, not just during bull runs. You get serious about tax efficiency. High turnover investments go into tax sheltered accounts, long term holdings stay in taxable accounts, and you start using strategies like tax loss harvesting to offset gains. Most importantly, you start asking a different question. Instead of how much can I make, you ask what's the probability of a major loss and how big could it be? Avoiding catastrophic downside becomes just as important as chasing upside. Because at this level, a single bad decision doesn't just hurt, it sets you back years. Your investing becomes a system, not a series of individual choices. A system designed to perform across different market environments, not just the good ones. Level 5, the high net worth investor. Your investable assets cross $1 million, and the financial world treats you differently. Doors that were previously closed quietly without explanation start opening. Private equity, venture capital, real estate syndications. These aren't investments you find on an app. They come through networks, advisors, relationships. The structure is different too. These deals require larger minimums. Your capital might be locked up for 5 to 10 years. Liquidity is limited by design. In exchange, the potential returns are higher, and so is the risk. The challenge at this level isn't access, it's selection. Because at $1 million, opportunities don't need to be hunted. They start finding you. Level 6, the professional investor, $10 million to $100 million. At this scale, investing is no longer something you do alongside your life. It is your primary function. A 5% annual return isn't a percentage anymore. It's $500,000 to $5 million. Every allocation decision carries real weight. You're running a diversified portfolio across public equities, private equity, real estate, and fixed income, each with a specific role. Here you stop thinking like an investor. You start thinking like a portfolio manager. Consistency matters more than any single win. Because at this scale, a major drawdown isn't just painful, it's hard to recover from. Level 7. The institutional investor. Hundreds of millions, billions. You're not picking stocks anymore. You're making allocation decisions. How much goes into equities? Into private markets? Into credit or real assets? You're investing through managers, hedge funds, private equity firms, venture capital, evaluating their track records and fee structures before committing capital that might be tens or hundreds of millions at a time. Liquidity is now a strategic consideration. You can't move quickly without affecting prices. Decisions are planned over quarters, sometimes years. At this level, your capital doesn't just participate in markets, it influences them. When you commit to a sector, others follow. When you exit, it's noticed. Information flows through relationships, not research platforms. Investing at this level is about directing capital at scale and understanding that the decisions you make ripple far beyond your own portfolio. Level 8, the billionaire investor. Net worth crosses $1 billion, and the rules change entirely. You're not thinking in portfolios anymore. You're thinking in positions. A typical investment isn't a few million. It's hundreds of millions deployed into a single idea, company, or thesis. You're not buying shares. You're taking ownership, influence, sometimes control. Public markets are still relevant, but private markets dominate. Direct deals, co-investments, large-scale placements negotiated quietly, behind closed doors, between people who operate at this level. Now your decisions have visible consequences. When you take a position, markets react. When you exit, it makes news. You can't move quickly. You move deliberately because you have no other choice. At this scale, investing stops being purely about returns. It becomes about influence, where capital flows, which companies get to grow, which industries get shaped. You're not reacting to the market anymore. The market reacts to you. 8 levels, one journey. Most people spend their entire lives at level 1 or 2, not because they lack intelligence, but because they never understood that each level requires a completely different way of thinking. The question isn't where you are right now. It's whether you understand what the next level actually demands. So, which level are you at? Tell me in the comments. And if this helped you see the bigger picture, hit subscribe. More of this coming.